Good morning. Thank you for joining today's daily webinar where we discuss your questions live on this stream here. So go ahead and continue to type over those questions and we'll field them here live on the air. We also discuss certain topics during these daily webinars. Today's topic is, can I open a solo 401k if I have a job? As always, please subscribe to our YouTube channel for more videos like this. Please share it with others in your network. Today's webinar is for educational purposes. I see we have a question here. I had an employee in 2025 until yesterday, her last day. Am I able to now set up a solo 401k plan? Great question. So I assume that the employee that you had was a W-2 employee and that he or she, or in this case, it looks like she, was a full-time W-2 employee, and also she was not an owner in the business. If that's the case, then yes, you can now open a solo 401k plan. I also presume that she did not have any funds in that 401k, and I also presume here that you do not currently have a full-time employer 401k, but rather you will be opening a solo 401k for the first time. Therefore, you'll be able to make contributions to a solo 401k plan for tax year 2025. And to get started, you can go to our online application and start the process. All right, let's see here. If we have any other questions for now. All right, again, keep shooting over your questions. We'll continue to field them live on the air here. In the meantime, we're going to get started with today's topic, which is, can I open a solo 401k if I have a job? And the answer is yes, you can, provided that you are also self-employed on the side. So many of our clients participate in multiple 401k plans. For example, some of our clients work for a full-time employer and they contribute to that full-time employer's 401k. And then they're also doing some moonlighting on the side, and it's just them in that business. In other words, they don't employ any non-owner full-time W-2 employees in that business. So they're able to open a second 401k. In this case, they're able to open a solo 401k plan for that moonlighting business. Contributions to the solo 401k plan would be based on the earned self-employment income from that self-employed business, not from their full-time employer business. What is more, many of our clients will utilize the Mega Backdoor Roth Solo 401k through our company. And even though they maximize their overall contribution limit to their daytime employer 401k, they're still able to fully maximize their voluntary after-tax solo 401k contribution up to the overall limit of $70,000 for tax year 2025, and then convert that over to the Roth Solo 401k or the Roth IRA. So in short, the contributions that you make to your daytime employer 401k, they do not impact the voluntary after-tax solo 401k contributions that you make to your solo 401k plan, as long as those contributions to that solo 401k plan are based on your net self-employment income from that side business. So in other words, you cannot contribute to the solo 401k based on your earned income from your daytime job and vice versa. So those are some things to understand when determining whether or not you can open a solo 401k if you have a job. So other items to take into account with respect to being able to open a solo 401k plan, even if you have a daytime employer and you participate in that daytime employer's 401k, or even if you don't, you want to make sure that that you only contribute again to that solo 401k plan based on your earned income from self-employment activity, not from your daytime employer 401k. Other items here that we see from clients that participate in both their daytime employer 401k as well as a solo 401k plan is the ability to also take a solo 401k participant loan, that is, borrow from their solo 401k plan. And they can do that even if they have an outstanding loan through their daytime employer 401k. So, in short, the ability to borrow from your self-employed solo 401k plan is not impacted by the fact that you might have an outstanding 401k participant loan through your daytime employer 401k. So essentially, you could end up having multiple loans, one $50,000 loan through your daytime employer 401k, and then a second one in the amount of $50,000 through your solo 401k plan. Other items to consider when contributing to both a daytime employer 401k plan and as well as your self-employed solo 401k plan from a contribution perspective, besides what we just talked about regarding being able to fully maximize your voluntary after-tax solo 401k contributions, regardless of the amount that you contribute to your daytime employer 401k, is the ability to also make other types of contributions to the solo 401k, such as employer contributions. So what that means is that even if you make an employer contribution to your daytime employer 401k, you can still make an employer contribution to your solo 401k plan, regardless of the amount of employer and employee contributions that you make to your daytime employer 401k. So those are things to understand when you're asking yourself, can I open a solo 401k if I have a job? Um, I don't see any other questions right now. We'll be back live again today at 1 p.m. Pacific time, and then we'll be back again next week as well as throughout the rest of the month of June. So it looks like we're starting a new month here next week. Until then, have a great rest of the day. Actually, it looks like there's a question that just snuck in here. Let's see here. I contributed to my Solera Solo 401k plan account before the 4/15 deadline. I then wired the money on May 15th to Fidelity to deposit specific pre-tax and Roth amounts and non-prototype account. Is that okay? So if you have a solo 401k with another provider, you're going to want to check with them regarding their particular solo 401k. But many of our clients do utilize Fidelity Investments to hold the solo 401k funds for the plan that we offer. So, but I'm trying to make sense of your question here. So if you have multiple holding accounts for a solo 401k, for example, you have holding accounts at Fidelity or at your bank for that plan, then that's not going to, then the movement of the funds between banks and brokerage accounts within that same plan, That's allowed. There's no impact from a tax perspective or reporting perspective because the funds are moving within the plan. All right, looks like we have another question here. Any big issues in rolling over a SEP IRA into a solo 401k? No, not at all. The regulations allow for the transfer of a SEP IRA to a solo 401k. As a matter of fact, over the past 10 years, we've seen a large increase in individuals transferring their SEP IRA to the solo 401k plan because the solo 401k plan is more robust over a SEP IRA for many reasons, including the following. One, you can make both employee and employer contributions to a solo 401k, whereas a SEP IRA only allows for employer contributions. Second, a solo 401k plan allows for participant loans, whereas a SEP IRA does not allow for participant loans. Third, the solo 401k plan comes with the auto contribution credit where you can essentially take a $1,500 credit dollar for dollar on your business tax return in $500 increments over a 3-year period. So effectively, the government is subsidizing the cost of having a solo 401k plan. That credit is not available to a SEP IRA. Another item to understand is that a solo 401k plan allows for voluntary after-tax solo 401k contributions as part of the mega backdoor Roth, whereas a SEP IRA does not. And that's just the tip of the iceberg. But the final difference is that a solo 401k allows for investing in life insurance, whereas a SEP IRA does not. And one final tidbit there is that if you invest the SEP IRA in real estate and utilize debt financing, aka non-recourse loan, it's going to trigger unrelated debt finance income tax to that SEP IRA, but not the solo 401k. If you utilize the solo 401k to invest in real estate, where the solo 401k utilizes a non-recourse loan. So those are just some off-the-cuff information regarding the differences between a SEP IRA and a solo 401k plan. Let's see if we have any other questions here. Um, Looks like we got a question here. What happens if I do a mega backdoor Roth conversion, but I don't file a 1099-R? Can I file it in later year? Well, I mean, number one, you don't want that to happen. That's going to increase the likelihood of an IRS inquiry or a full-blown IRS audit, which obviously nobody wants. But if you did not issue that 1099-R timely, then that can still be issued. After the fact, the IRS may charge you a $50 late penalty, but really the more important item to consider is that you want to make sure that in fact you did convert those funds in the year of the conversion. In other words, you can't go back now and say, well, I'm going to treat it as if I converted out last year, because it's too late. Because keep in mind, conversions are reportable in the year that the funds are actually physically moved or the assets are physically moved to the Roth account. All right, let's see what other questions we have here. Are solo 401k contributions typically made through payroll or directly by employee and employer? Great question. So they are typically made directly from the employee or the employer. Not many, very small percentage of our clients utilize a payroll company because that's just added fees that are not necessary. Because, for example, many of our clients will use Fidelity Investments to hold the solo 401k funds for the plan that we offer. So Fidelity Investments will provide a non-prototype brokerage account for the plan that we offer, and you're able to actually link the bank account to your Fidelity brokerage accounts, and there's no fee for that. Whereas if you go to a payroll company, they might charge you a fee. But if you do go through a payroll company, many of our clients do use Gusto, and we have a great page on our website where you can integrate Gusto with the solo 401k plan that we offer, and we got step-by-step instructions here. Let me share that link here. But no, most of our clients don't utilize a payroll just because that's an added fee that's not necessary. If we were talking about a full-time employer 401k where you have many participants in the plan, then that's a whole different story. But with the solo 401k, it's for owner-only businesses with no full-time W-2 employees, so it doesn't make as much sense. So there's that link there. Oh, let's see what other questions we have here. All right. Um, looks like we've gone through all the questions for today. Again, we're live every day at 10 a.m. Pacific time, so if you didn't get a chance to shoot over your question, there's always next time. Until then, have a great rest of the day.